LIBOR stands for London Interbank Offered Rate, and it is the bedrock interest rate that other interest rates develop from. If you're wondering why LIBOR has been in the news, well, it has gained notoriety from being manipulated by the major banks, which has led to multi-million fines for Deutsche Bank, Barclays, and Rabobank, but we'll come to that later. It is important to note that the rate's influence extends far beyond the capital and the UK despite its misleading name, and it is a globally used yardstick for short-term interest rates. So how does LIBOR work? The short answer is that LIBOR represents the borrowing costs between the world's largest banks. In other words, it is the benchmark rate at which major global banks lend to each other in the international interbank market for short-term loans. This rate is significantly lower than the interest rate that banks charge individuals. The rationale for that is that banks are much more reliable at paying back their debt than you or me are. And the low interest rate a bank receives reflects that low risk equals low return in financial markets. However, note that there is still a remote possibility of the bank's non-repayment, therefore the credit risk element is calculated into the rate's price. And you may be wondering why banks lend to each other after all. And there are three main reasons. Firstly, fractional reserve banking. Banks are only required by law to hold a fraction of the money that is deposited with them at any time. The other sum is lent out to make more money, and the bank makes profit by charging borrowers interest. But when banks get a reputation for suffering losses due to liquidity concerns, panicked customers might do a run on the bank to get their money out. The bank may therefore not possess enough to pay all of its depositors back, and it will need to borrow money from another bank. Secondly, regulatory capital. Following the crisis in 2008, legislation has increased the amount of reserves that banks should constantly hold. Therefore, borrowing may be undertaken by a bank to top up reserves to meet the amount of deposits required by statute, and this is called regulatory capital. Thirdly, profit maximization. Banks are considered trustworthy borrowers and they can borrow at low interest rates. Therefore, Bank B will borrow from Bank C because Bank B knows this loan will be offered at a low interest rate, and Bank B will make profit lending to a customer overnight, while Bank C loans the surplus unrequired money and profits by charging interest, and they both win. Now let's look at LIBOR calculations. There are 35 different LIBOR rates each day. LIBOR is quoted for 5 separate currencies: US dollars, euros, UK pounds, Swiss francs, and Japanese yen across 7 time intervals: overnight, 1 week, 1 month, 2 months, 3 months, 6 months, and 1 year. LIBOR used to be published daily by the British Bankers Association, or the BBA, which is a trade association representing the views of those involved in British financial services. However, the FCA reassigned supervision away from the FBA once evidence of LIBOR collusion to manipulate the rate was revealed in 2012. And these days, the rate is calculated and published each day by the Intercontinental Exchange Benchmark Association, or the IBA. Historically, LIBOR contributing banks were each day asked, how much are other banks charging you in interest to borrow today? And submissions were estimated based on 2 key information sources. Firstly, the rates revealed by the bank's underlying transaction data, which is the actual borrowing transactions made between the bank and another bank. And secondly, panel banks were also allowed to provide an estimate of their cost of borrowing based on the expert judgment of the bank. However, there was a problem with the expert judgment element because banks were likely to portray themselves as having far better credit risk, and they suggested they could borrow from other banks cheaper than they did in reality. This allowed the banks to receive essential loans in the event of an emergency and raised confidence regarding their solvency, and it led to a manipulation scandal leading to massive fines. Now let's look at the changes to LIBOR. Following the 2012 scandal, the IBA altered their methodology for LIBOR calculation, and it now seeks to rely more on the transaction element rather than the expert judgment aspect of the panel bank estimations. In 2017, LIBOR was to be discontinued, and banks agree with that because they wanted to stop providing LIBOR estimates as there was always a risk of them being fined by regulators for potential manipulation and a risk of litigation. In 2022, there is no guarantee of relying on LIBOR anymore, and alternative benchmarks may be introduced. However, there are problems with these alternative benchmarks. This would be a massive change because LIBOR is now present across all financial contracts, it is incorporated in loan agreements, and it is used on LIBOR-based derivatives. There would also be operational problems because it is built into the algorithms of computer systems and changes would require a lot of work. Adoption and coordination problems would also occur as institutions don't want to be tied to reference rates that are not commonplace.